All right. Good morning, everybody. Man, this windstorm yesterday just broke a lot of stuff, messed up my breaker box, fried some stuff in my office. Anyways, this is the YouTube. I just wanted to point out that I did add some charts this morning. If you're not subscribed, please go over there, like these videos, subscribe. There's going to be a lot more content coming out next year. But I had been talking about the steps to the morning briefing and the charts that we use. I haven't reviewed the old charts that I had on there, but I'm pretty sure I'm using newer setups. So I didn't remove the old charts. I just added new charts. What you'll want to do is go into the video details, scroll down where it says TOS Charts. I have a little note there talking about where to look on Thinkorswim, in the upper right corner while I'm going through the charts, and how the names of these charts will match that, right? So these are the chart share links. And once I do the trading view charts, they'll get added to this too. Of course, there's some limitations, right? Because TradingView doesn't have all of the options data that Thinkorswim does yet. So just pointing it out there that I'm working on it. I need some help getting that channel up and running. It's got years of these morning briefings on there. You can see the consistency of it, right? I've been working on this morning briefing for years as one of my own personal projects. Is we got to eat, right? Got to pay the bills, and making money in these morning trades. It's a way to get it done. So let's look what's going on out there. Japan is up close to 1%, and the S&P is basically flat on the day with the Dow. We were, before we lost power yesterday and had all these shenanigans, we were talking about the seasonality or the repeatability of triple witching and its effects on the market. And I don't know. I didn't really like the data that I had come across because you can't do it just so generically as saying, how does triple witching generally affect the market? That's too vague. It's too broad. You got to think about, was it an election year or not? Was it during a rate hike cycle or a rate cutting cycle? There's so many things that affect it. And then what part of the year was the triple witching? Was it, the December triple witching, or is it the March one? So I didn't get an answer, and I ran out of time when the power went out. Might do some more digging around today. I think one of the takeaways is that there's anticipated to be a lot of volatility, and that oftentimes we end up pinning. So we'll see how it goes. Anticipate the hurry up and wait behavior. It's kind of my baseline bet. The numbers aren't wide here for what we have coming in. Don't really have a lot of expectation for shenanigans. It's always possible. Maybe we see a little bit of move after Europe closes. So, keep your eye on that. If you're not sure of when different nations close around the world, then there is a website for that. It's called tradinghours.com. Hey, can you move? This is my desk. Jerk. My cat thinks he owns the place. Vámonos, gato. And he always wants to eat my mints. So, trading hours. This website, it's free. It doesn't cost you anything. You can go here and see what nations are open, what are closed, when they open, if they have holidays. I'm just a typical American. I don't pay attention to anybody else's holidays. It's hard enough keeping track of our holidays, let alone somebody else's. So I never remember. This is a great place to check to see if a market was even opened today somewhere else in the world. And it uses their local time zones too, so you can set your charts to that time zone if you need to. I often do that with Tokyo. Well, I used to when I was trading in the nighttime, so that way your charts match their time. It's a great website and it's free. It doesn't cost you anything. So keep track of things when Europe closes today. See if we get any shenanigans out of them. There's supposed to be another announcement from the president tonight. Okay, this afternoon. I could have swore they were talking about, yeah, tonight. So both. We're going to get one this afternoon, makes an announcement from the Roosevelt room. And then tonight, he's going to deliver remarks on the economy at 9. Of course, we'll be done by then, right? That's going to be a Rocky Mountain, North Carolina event. And this is the one that we need to worry about. Also, the Epstein files are supposed to come out today. We don't know what time today, and we don't know how heavily redacted they're going to be. Who knows what we're going to get, right? I mean, it's like watching a NASCAR wreck in slow motion. And of course, everybody goes to the races to watch the wreck. Love to see a dynasty get ripped apart when it was built on something shady, but I wouldn't keep your hopes up, right? Powerful dynasties have a way of self-insulating. So maybe we get to see some shady people taken off the board, but I wouldn't hold my breath. One thing I can absolutely say, like we've seen it put in the chat more than once, I don't care if the files get released. I'm not in them. All right, we haven't looked at the CTA charts for a little bit, but we can see we're doing just fine. We're not matching the price action, not even a little bit. So this run back up to the previous high, they didn't even bother, right? That would have gotten them back up to around 3.5, 3 3/4, and they didn't. So we could say it was their lack of participation that caused this to fail. I don't, but we could say that. Either way, the push now to try to retest this high and maybe get back up toward the top there still shows that CTAs aren't allocated heavy in this market. They have plenty of room if they want to start getting involved. So we're holding up out here without their assistance. We can see also that it's not like sold to you at this point. We don't see them looking for ways to pawn off their position onto retail yet. I'm still bullish into 2026 anyway, so I don't think they're going to be wanting to unload like that, not that caliber. Gold, if we continue to look back at the previous allocation heights that they set, then this new little breakout is curious, but there's still room left if they want to allocate more. We do have to be a little concerned, but we are back to this previous high, and we can look back and see that we've got more room should we need it. It's a little concerning because they do have a habit. If you look at how gold acts, they do have a habit of following the stall. And when we say stay sideways like this, they run sideways and or start to de-risk. A little pullback in silver from their allocation levels, but that's it. There's not even a whiff that they're trying to get out of their silver. Elliott Investment Management has built a $1 billion stake in Lululemon. Remember 4 or 5 years ago, Lulu was a joke, right? Everybody was always making fun of it, talking trash. Who's laughing now? Not me. I didn't have it for 5 years, but I'm sure there's some bag holders out there that are just tickled. The OPEX this week is supposed to be some tremendous, massive, never seen before sized OPEX. And once we get into 24-hour options trading, we're going to see whole new levels, right? So all these levels are going to get broken anyways. All right, so this is what I mentioned in the YouTube description to keep your eye on the upper right part of my chart as I'm working through Thinkorswim. So if you're downloading the quote active chart, it's this one. Got the spot gamma levels and the overnight cumulative volume. Volume last night, 70,000. They're not sitting out. Of course, a lot of this volume is likely attributed to the roll. They're triple witching, rolling their positions. Looking at what happened last night, we're hanging out at the volatility trigger. The put wall moved back down to its previous level. So as I mentioned yesterday, just because it had rolled up, one day didn't matter, and we needed to see where it was at the next day. And well, it went back where it came from. We're fighting against 6850, wasn't able to keep it last night. We're inside day, which is a really big day. Doesn't look like much from here, but looking at it on the daily, yesterday was a really big day. We're underneath all of those averages, fighting the 3 and the 50, but otherwise we're just tangled up in all of this mess. And it's very likely that we go into the weekend tangled up inside of all of this mess. It doesn't owe us anything today, right? Now, the way that things went down this week and the lack of crashing and burning in the AI theory and theme and space, especially with the threat that MU was posing, it's very likely that we get that some sort of short week rip and that we can jump up above 7,000 and get into, I don't know, 7050, 7100. It's not off the table, but in those short week environments, the low liquidity gives us the potential for really big moves. I know that new traders might not grasp that logic, but the lack of participation can facilitate big moves, right? Because we have to ask, what's moving price? And if there's not a lot of traders, then it doesn't take as much to move price. One wrong headline, one bit of news taken in the wrong context could put us below 6,600 and get us down into 64, down into this 200 period daily moving average. That's not my baseline bet. I have no reason to believe that we're going to see that level anytime soon. But it can happen. So if you wanted to get a lotto play or something like that, why not, right? Just remember it's a lottery ticket. It should not be expensive. You don't mortgage your house to buy a lottery ticket knowing you've got a 1 in a million chance of making any money on it. But that's also why, the lottery tickets are so cheap, because you have a 1 in a million chance of making any money on it. So risk $1, risk $2, call it good. And if nothing happens, then so what? This is not a hedge by any means. It's not even really a trade. It's just a coin toss. All right, this is the ADR chart that was shared. I typically do have a second chart for a lot of reasons, including the fact that it gives me a chance to scale the chart that I am looking at. So that right one's there, not really paying much attention to it. This is the one that matters. It's the ADR lines and then the market maker move if we have one. During triple witching, we get the market maker move all week. So unfortunately, even if there was something really big today that we needed to be worried about, we wouldn't know it because we'd already have a market maker move because of the triple witching. It's unfortunate. It's just the way it is. We are within the ADR lines today. We could hit the upper ADR half without even taking an inside day breakout, and we could hit the lower ADR half without taking an inside day breakout. So it kind of reinforces the idea that today's going to be an inside day. We're not going to get anything done, and that the best case scenario is that we tag both sides of these today and we call it good. Before I lost power yesterday was a pretty good trading day. We were playing it to the upside, playing it to the downside, perfect targets, perfect halfbacks, and it was just really consistent. I'll take it, right? Take what we can get when we can get it. Even the breakouts and the breakdowns into the new low a day was just really nice, right? Look at that 111 reversal. Step by step, and it did exactly what it was supposed to do. On the flip, went right back up to the half. I mean, it just fantastic, right? Really, really good trading day. And then, well, then I didn't have any power. So let's hope that today, if we're going to stay range bound, has these same clean swings and that it doesn't look like this, right? Because that's not really what I want to mess with. Other than that halfback right there, that's a really nice halfback. I'm going to take that. All right, now this is the CPR chart. CPR stands for Central Pivot Range. Thinkorswim doesn't have a central pivot range. I had to build this, but TradingView does. So if you're over there, you can just type in CPR or central pivot range, and you'll find something similar to this. I'll be sharing the one that I made that makes it look just like this. But the size of the channel is important. So we want to look at the daily channel, today's channel, and today's pivot is higher than yesterday. That's bullish. Price opened underneath it. That's bearish. Those two kind of cancel each other out. But the next thing you want to look at is how wide is this channel? A wide channel implies that if we try to break out, it likely won't work and we come back in again. A narrow channel implies if we break out, it could stick and we could just keep the breakout and keep on going. Today's channel is that kind of channel. It's very narrow. Now we can still see a channel if we zoom in, but it could be so narrow that you don't even see the yellow lines. You don't even see a channel because they'll hide behind the floor pivot. It's not doing that today, but it's really narrow. Keep in mind that this channel and this floor pivot, it doesn't make price do anything. So we won't break out because of the pivots. We won't not break out because of the pivots. Whatever we do today in price is not because of these pivots, because these pivots don't make price do anything. They are our read on what to expect out of price today. They are not influencing price. We're underneath the weekly pivot. We are considered bearish as long as we're underneath that weekly pivot, and we need to get back above it. But this is not like yesterday when we got above it for a little bit, or on Wednesday when we were above it for a little bit. We need to be sustained above it. So these little jumps above and then back down, this wishy-washy cross the fence kind of stuff, that is not us going bullish and bearish and bullish and bearish. We're just bearish since Wednesday. And that's when, well, since Tuesday, maybe. And that's the way we need to read it, is we're just straight up bearish until we get on the other side of this. But we haven't continued to expand lower. So we could say bearish neutral, or just neutral, that we're flat, we're hanging out. We got to get some event, some catalyst that can get us out of this mess. I mentioned the TRB earlier this week, and the possibility that we could build out a base down here and then run back up. Now, if we built a base and we run back up, you can see that that forms a cup or a scoop pattern. We'll take it. There's nothing wrong with it. It's fine. And a lot of times on the way back up, you'll get multiple candles that form the other side of this. And there's nothing wrong with that. But I like the TRB better. The TRB would be that if we came down here and we get one inside day, and then the next day, which would be this day, we go all the way back to the top in a single shot. In a single shot, one day, one big bar that runs it all the way back up. That would be a TRB. It's called trendline breakover. And when I was naming it, there was a reason I didn't put TLB, which would be a trend line breakover. I don't remember why now, but I must have had a good reason. So I did not use TLB. And instead I used TRB, right? Trendline breakover. I don't remember why, but I trust the process. I must have had a good reason. So if we're going to get that TRB, it would be today. It would have to be this day's bar, breaks above the 10 and the 20, and then out of yesterday's high, and we start running that popcorn pop all the way back up. The popcorn theory is from Rob somebody. Can't quite remember at the moment. The idea being that if somebody was short, their stops would be here and here and here, here. And of course, if you're short, your stops are buy orders. So if price gets to ripping and hits those buy orders, it fuels the buying, gets us ripping up into the next level. More buy orders fuels the buying. More buy orders, more buying, more buy orders, more buying. Back up to the top, right? Just triggering stops all the way up. It doesn't really matter if you subscribe to that theory or that logic or not. If it's there, it's worth looking at. You can watch it on the dome and see the order flow and the tape and the participation as we make that run. We do need to worry about the halfback. So if we start this process today, the halfback is 68.78. Once we get through that, we will be through everything that could interfere with our plans, and we can run it back up. It is worth noting, if we get this run today, 69.20, it's the halfback of this big red bar, and or you could run the halfback on this blue bar here. I kind of like that blue bar. Honestly, I like that a bit more. That blue bar, while it doesn't look like much, is half of this entire range. It's a big bar. All right. And of course, we got our cog lines and the roundies that we can mark out as well all the way back up. That's if we get it. And I don't have my hopes up that we're going to see it today. Certainly don't. But we'll take what we can get. I don't think it agrees with me. It would be nice to get it, but like I said, I just don't see it. Sideways is the base case argument. Now, while we're here, I always leave these turned off until I need them. Double click on the channels and this pops up. And we want to turn off whatever's hiding our pivots so that we can see them. These are the pivots that I just unhid. We didn't even make it to R1. It's very likely that we stay between R1 and S1 today, which is lining up really nice with yesterday's high and yesterday's low. Not a coincidence. The base case argument that today is a sideways day is still, I'm confident in that. I will be fading a breakout up the high, and I will be trying to buy a breakout from the low, depending on how we break out, right? If it's news and a waterfall and we're cascading to the downside, heck no, I'm not buying that. Just have to see how we work our way down there, right? All right, volume profile 65. That's how it's titled. This is a 65-minute chart. The profile spans for an entire week. So it's 5 days, and then we get a new profile, and it's 5 days, and then we get a new profile. But these bars are 65-minute bars. The profile on the week, it's relatively wide, and all of the work is packed into the middle. Got a little bit of a bump down here. You can see how the buyers stepped in, tried to run that back up. Nice defense. We'll see if it sticks, because we might end up retesting that today. I'm hoping that don't happen, but we could test their resolve. Can also see that trend line. I don't need to draw it. If you've been around the trading world for a while, you should be able to see it. That would just be more of your regular scoop style trend line breakover with a kind of a cup pattern back to 69.80 area. This is your classic distribution D-shaped profile hanging out near the mid. If we can get through that point of control, then get through the value area high, there's nothing left until we get back to this gravity point, 69.11 cog line, the center point of last week, the profile. To the downside, I mentioned it earlier this week. Hopefully you caught that in the stream. If we continued to the downside, the only thing that we had down there that might help us out was that point of control. You remember? Yeah, I remember. It worked. Question is it going to hold if we happen to go back there, right? Because first we bounce, then we break if it gets retested. So that is still on the books. It held. Yeah, we wicked through, but it's still there, and we're not done with that level. So keep that one on your radar. Come on, Thinkorswim. It gets a little scared. 10-day, 30-minute volume profile and TPO. TPO is in blue on the right. The volume profile is green. It's in the center or on the left. The chart's starting to get uglier and uglier again. We've now got 2, maybe 3 distributions. We're building one out here. This could become our new point of control if we stick into this range into next week. The question is, are we still going to be here next week, or will we have changed this address? So if we break back out to the upside, we want to focus on getting back above that point of control and try to put in some work up here the way that we did down here, right? We want to try to keep this as reciprocal as possible. Otherwise, breaking to the downside will expose us to new profile on the left, and we would be looking to bring this point of control down to this 68.42 old school cog line. volume profile 5-day 5-minute. This is often called my 5x5 chart. Usually the chart's not even on a 5-day because I want to look back farther than that. I end up putting 20, 30, 50 days on it, but it's still the 5x5. So if you ever see one of my videos where I'm talking about the 5x5, well, now you know what I'm talking about. We're looking for an untouched point of control from the previous day's range, and we don't have one. You can see that we passed through that point of control a lot last night, so no help there. The textbooks would tell you to bring it forward anyways. The value area high, the low, and the point of control should be carried into the next day's trading every day. That's what the textbooks say. I've got enough pivot points. I don't need to do that, but you do you. If you did bring that forward, you can see how the Globex ran up into the value area high, and that's where we stopped. I don't even think we made it to the value area low today. They took a front run on it. And we've been interacting with that point of control all night, so that's not really very helpful today. Yesterday, we ran into a bunch of sellers. The question is, are they still there today? So that's what we want to be watching for. If we get that breakout of our own Globex high and we make a run towards yesterday's high, it's not just yesterday's peak. It's this entire range that we need to be worried about. Hopefully that stands out, right? Pivot point trading, we can just draw a single line in the sand and say, yeah, when we get there, we need to be concerned. And sometimes that's what we do, right? Yesterday's high, yesterday's low, today's open. It's just a single line. But sometimes we have enough data to say, look, it's the entire box. That's a 10-point zone that we really need to pay attention to. And we've already got evidence that the zone is what we need to focus on. Because when we left that zone and tried to come back into it later, we weren't able to get through there, right? And this is the 1, 2, 3 fail play. Oddly enough, we didn't get it, right? So usually it's 1, 2, 3, and of course it can be 1, 2, and then jump. There is no 3. This, we ended up just stalling out, and here we've just, been baking since then. The 1, 2, 3 fail play has been around for a long time. But it didn't follow through, and they're not usually so big. Usually it's a lot smaller than that. The distribution today on those profiles were not helpful. There was nothing intraday so far that would help us out. The indicator for the weekly expected move, this is the weekly EM. That's what the EM stands for, expected move. This one will not be on TradingView because this one needs options data that TradingView doesn't have yet. They're working with Tasty Trade. They're getting more and more options data every week coded into the platform. By next year, this time, I wouldn't be surprised if we have an entire options, all the options data on TradingView. But we're not there yet. So this one needs the options data. This one won't be on TradingView. It wasn't working this week because this week is triple witching and it's the new contract, and that's the way it works a lot. We've seen that in the past. It is what it is. But we have next week's, and it should be concerning with how wide next week's range is. This range is derived by 2 math pieces. One piece is time, and the other piece is volatility. Next week is a short week. If we compare the next week to, say, the week where we had FOMC, they say FOMC is volatility suppressing. That really shines right there. That's a great example of it. See how narrow that week was compared to the range we're going to get next week. But it's not just that. If we have a known unknown, CPI, PPI, FOMC, non-farm payrolls, the markets will price in a sideways week. They'll price in a smaller weekly expected move. Because if we're going to go sideways for 2 days, then, we're not going to travel as far in the other 3 days. When there's nothing like that on the books, then they focus on more of the volatility aspect. Next week's range is wide. and it's not a full week. It's one of the shortest holiday weeks, or it is a short holiday week, not one of the shortest, but it's a short week. And yet it's a wide range, all things considered. We want to see how it ends and what it looks like next week. Right now, this is just a preview or a projection. It won't lock into place until after the close tonight, sometime around 4:15, maybe 4:30. It'll lock, and then that's it. Then it'll be like these in the past, to where we can look at it and view it, and it won't move. But throughout the day today, it's going to continue to move. Price is that gray line, and then you have the green and the red, and everything is moving as price moves. So let's see how the day ends, and we'll review this on Monday and see how much bigger or smaller the box is. If you don't have Thinkorswim and you don't have this weekly expected move indicator, you're not missing out. You can draw it by hand. Now, if you're trading the futures or you're just doing the indexes, drawing it by hand really isn't a big deal, because it's only, maybe 3 or 4 markets that you have to mark. But if you're an equities trader and you are doing it by hand, well, that sucks, because then you got to draw it on everything out there, and you have to do it over the weekend, because we're using an expected move that is locked on Friday. It's static. If you do it every day, like if you just want today's expected move, it's right there. That is a dynamic expected move. It's moving. It is dynamic. We don't want the dynamic one. So on Friday after the close, if you're doing it by hand, go in, look at next week's expected move. We can see that it's 99 points. Let's round up, because you can't do a half of an 8/10 of a point. So it's 100-point higher and 100 points lower. That's next week's range at this moment. After the close today, come back and look at that number, mark them out on your chart, and you're done. Then you've done it by hand. And yes, doing it by hand is way more accurate than using that indicator, because the indicator actually can't see this data. I don't know how Mobius coded that thing to work either, because I code Thinkorswim, and I've looked at the code, and it doesn't make any sense. And I don't know how he did it, but he did it. It's still not as accurate as doing it by hand. But if you're going to look at 120 something equities, then it's certainly better than doing it by hand. All right, we are still below the 10-day, but we're working our way back up. Nothing extreme, just taking our time, nice and easy. And that's exactly the kind of price action we want to see. No sudden moves, nothing violent and extreme. We're just working our way back up. But we do have to be concerned with the question of what happens if we reject it and don't get back up. If we come up and tag the underside of it and then begin to work our way back down again, and we get a lower low in this, well, that's not going to be cool. I don't think the markets are going to like it that much. And I think that would put 6,500 back on the table. But we're not there yet. We're just filling this out. So far, so good. Nothing wrong. Nothing to see here. And if you think about that imaginary collar that I've talked about before, there's a 0.5% below and above, and then 1% below and above that collar. Well, we're inside of it. So no risk, no danger, no extreme moves. We haven't moved too far, too fast, and it does not owe us any sort of mean reversion, least squared method, dot plot statistics, or anything else. All's good. Now that's the daily. So you could pop it up, swap it over to the weekly. Things are looking good here. We're less than 1% above the 10-week. We do have this recurring theme of lower highs that we need to deal with. Really looking for a breakover on that. And to see next year, we're working up through the 3.5% and the 4% range. But we don't have that at this point. And you can see that we've been working on this downward slope since we recovered after April of this year. So, we were really giddy through May and June, bit of July, and then it's just been an ugly grind to the downside. Still, doesn't matter, because all of that was above the 10-week. And as long as we're still above the 10-week, then we're still all right. We start hanging out below the 10-week and, well, things are going to get a lot uglier, like coyote ugly kind of stuff. So those are the charts that I shared. You should have access to those now. The ones that we can build on TradingView, we'll be adding them to the list. You should find the watch lists, but I'll be updating all of the watch lists in that YouTube description as well. So you'll have the watch list. I've got write-ups on what is in here and the steps that we take through this morning briefing. Because remember, the only reason I do these is to teach you guys how to do it for yourself. Yeah, I'm giving you a fish today, but I'm really interested in teaching you how to fish so that eventually you don't need me. You just do this on your own. Bonds are down. Mag 7 down volume is down. Got a little bit of bond shenanigans this morning. And really, and the VIX is down. And that's about all we have on the downside. Now, looking at what's up, we got a lot of stuff that's up that isn't meeting our qualifications, looking for 0.5%. But we still have a lot of stuff that is meeting our qualifications. Now, look, I do these briefings early in the morning because I got a lot of things to do before the market opens. But if you're going through these steps and it's, 8:45, 9 a.m., 9:15, you're going to want to move your qualifications up. I use 0.5% because we started at 8:30. You could use 1% or 1.5%, maybe 2%, right? Just really tighten that number up. There's no magic to 0.5%. It just, at this early morning time, 0.5% works good for me. So looking at what's up this morning, we got Bitcoin and more Bitcoin and more Bitcoin. UFO. So we should be expecting more of those small cap moves. China, more China, and then China and chips, SMH. There was a publication I was sharing yesterday about TSM and MSCI. It's this really awesome correlation between the output in Taiwan semiconductors and the 12-month lagging effect that we see globally based on the supply and shipments and behavior of those shipments. So it was a good read. It was just a little excerpt, a little headline. The bigger read was a big PDF that I didn't share. But the forward outlook over the next 12 months, as long as the output continues to shine on a month-over-month basis, it's looking really good. And you add that to the big beautiful bill passage and all of the breaks that companies are getting with that. Like there's just a whole lot of positive into next year that may be a bit complicated for the typical retail traders like us, and definitely out of our depth because they're not in the candles, right? If we're just looking at the Qs and SPY, we don't see all of that. So there's a lot of reasons to expect more upside next year, as long as the AI narrative doesn't get broken, right? If that doubt creeps in and the narrative breaks, well, then we'll have to come up with something else. So chips are good this morning. Uranium, generic tech, gold miners anyways, junior miners. They're not quite up enough. We need a little bit more out of them. Pot stocks are up the most, almost 6%. And then Bitcoin, China, solar, crude, silver, chips, uranium, miners, the Mag 7, airliners again. Nah, it's just an algo print. There's nothing there. So we have the capacity to get this breakout and this move to the upside today, just based on what we have right now. That's all we need, really. With these sectors up and the lack of really big news, we've got all the ingredients for an inside day breakout and an upside breakout at that. But I'm not holding my breath with any expectation that we're actually going to get that today. My base case is that we're going to hold the line and go sideways into the close and look to stabilize the week. Right? So here's the daily chart. If you think it through, staying inside of yesterday's range builds out that base at the bottom of this cavern that I was talking about, right? Just sitting down here. If we finish the week out sitting inside this range, then it opens us up for a really nice, say, gap down on Monday, get a little 111 or 1236 to the downside, and then run it right back up. Or that we start the next week continuing this base sideways and then work our way back up, something like that. On the weekly, if we're using TRB, then we're building out that megaphone pattern. Not TRB, the OCR. OCR is a type of technical analysis that runs candle by candle instead of the more legacy systems. So with OCR analysis, we'd be looking at that as a megaphone pattern. Let's see how the week closes and what we end up with. But holding the line into today's close, if we break yesterday's high or yesterday's low, I would see it as an opportunity to take the other side. That's going to be the way I play it today. And if I'm wrong, the loss should be small, right? Because, I mean, I don't trade with big, massive stops. So if I'm wrong and the breakout sticks to the downside, we'll still have the other breakout to do because I'm going to run the RTH and then the real low. Those are two different opportunities. And to the upside, if we're wrong, then we're just going to run it up to this other level and then try to run it above that, right? Recoup from the wrong trade and take the right one. So what I got for you guys, be careful, be safe. Let me know if you have any issues with those charts or if there's anything on there that you don't understand. The write-ups that I've done over the years should explain the tools that are on it. Plus, you see me use them every single day. Enjoy your weekend, everybody. I'll see you next week.